Hello, this is Kurt Schuster with QOLity Financial. Thank you for taking the time to review our content today. Purpose for this video is to give you an idea of our outlook for the year ahead, 2016, and a little bit of context as to why we have that outlook. As you notice, the theme is embracing the routine. Really what we expect is for 2016 outcomes to end up being a routine year in a lot of areas of both the economy and the financial markets. However, how we get there might be a little bit out of the routine. So it's going to take still some solid investment planning to navigate throughout the course of the year. Our expectations as a whole, we think our economy is going to grow at 2.5% to 3%. We think our stock market is going to be mid-single digits, so somewhere between 5% and 9%. And we expect bonds to have a flat year. Some of the reasoning behind that, the themes that we have here in 2016. First and foremost, the Federal Reserve starting to raise interest rates for the first time in over 10 years this past December. We expect that to continue throughout 2016. Oil. The big story of 2015. We think that at some point this year we start to see a stabilization in oil prices. And thirdly, earnings. A lot of 2015 corporate earnings were impacted, again, mainly by energy. When you take energy out, earnings have been solid. But as those oil prices stable, we think as a whole, for our overall stock market, earnings begin to recover. So let's talk a little bit about why we think our economy continues to grow at 2.5% to 3%. If you look at the chart on hand, the composition of what makes up what we actually produce as a nation has certainly changed over the years, but we've held steady at around 2%. So a 2.5% to 3% expectation is actually above what we've averaged since the last recession ended in 2009. We've talked a lot about the economic cycle in some of our meetings, some of you that are current clients. And our expectation hasn't changed. We still think we're somewhere in the mid-cycle range, maybe past the midpoint, but the chart that you have on the screen here measures a multitude of economic indicators, key data points, that you can see where they typically are in that overall business cycle. So again, we think we're somewhere at the midpoint of that economic cycle. Other things that are going to impact the economy this year. Again, we still haven't felt the full impact of lower oil prices. As you can see, countries that are net importers of oil are going to benefit from that. It's the countries that are net exporters that are really being hurt as a nation by those lower oil prices. We haven't experienced it yet, and we think we'll start to see more of that impact filter through our economy. Another aspect is China. A lot of the big news is China's economic slowdown. That's certainly in the headlines. If you look, there's short-term factors. The percentage of our exports to China in the United States is roughly 8%. So not that there's no impact, but a very small impact to our economy by really what's happening to China. It's really the nations closer to them, particularly Australia, that should have a greater concern with China's economy, since over a third of their exports are to China. So with that, our overall outlook on the economy, I'm going to turn it over to Benjamin Barnhart to spend a little bit more time on some specifics in the stock market as well as the bond market.
All right. Thanks, Kurt. So I want to expand a little bit more on why we believe stocks are going to finish between 5% and 9%, and our convictions behind why we believe this year will be a flat return for the bond market. So as far as the stock market's concerned, we expect a return that's consistent with historical mid to late cycle economic performance, and will really be driven by earnings growth as well as a stable price to earnings ratio. So another important topic that I want to make quick mention of is that it's an election year, which typically tends to be a difficult time for Congress to pass legislation. However, since 1950, the S&P 500 returns during election years have averaged about 7%, with the third year usually being the big year. So it's still something that we want to keep an eye on, and throughout this year have continued discussions as we progress through 2016. So given our view of the economy and it being a mid-cycle year, we have high confidence that the range of potential likely market outcomes here in 2016 is going to fall into those highlighted in the figure above. So we believe that the worst returns as well as the best returns are unlikely, so due to unusual circumstances during those years. So if we peel those off, that leaves 5 to 25% as a range of potential outcomes, with 5 to 15 being the most likely. So as Kurt already mentioned, we expect 2016 GDP growth to near its long-term trend. Corporate America should then get back to delivering some solid profits with mid to high single-digit earnings growth, helping us push the stock market higher. So last year, energy earnings were down about 60%. And Thomson Reuters consensus estimates expect them to be flat for 2016. So really just that improvement alone should help with overall earnings. Volatility, which we saw a fair amount of in 2015. The S&P 500 actually crossed the 0% trend line over 30 times last year. And even bigger pullbacks, such as the one we experienced in August, are actually quite normal or routine. So since 1950, the average peak to trough decline for the S&P 500 is 14%, and even in years where the market finished positive, the average was 11%. So whether they are of the 5% variety or 10% variety, certainly anticipate some sort of pullback here in 2016, and our challenging start already to 2016 certainly falls in line with that. So the first week for the markets this year is actually the most challenging start since 1991. But interestingly enough, that year the markets actually finished up over 20%. Now, that being said, we don't believe that to be an overwhelming possibility, but instead allows us to remain cautiously optimistic as we experience some of this volatility. So some routines are going to be more challenging than others, and sticking with bonds might be one of them. A limited return environment is likely to persist here in 2016, and the year as a whole might look very similar to 2015. So high valuations, steady economic growth, recent Federal Reserve rate hikes are likely going to keep some pressure on bond prices here in 2016. So we don't envision a recession developing, which we believe is ultimately needed for a sustained move higher in bond prices. And that being said, you might be asking yourself, with such a dismal outlook on the bond market, why should I own bonds at all? And I think this chart here does a great job of answering that question. And it's really because bonds still play the vital role of diversification, even despite prospects of low returns. So over the last 12 years, high-quality bonds have provided a key buffer during periods of stock market weakness. So while the average absolute return from bonds was low, risk mitigation was still the key factor to why investors should still own bonds, especially if they're in a position where the losses are going to hurt them more than the gains are going to help them. So when a bond's interest rate goes up, bond prices go down. And I think it's important to be aware of that inverse relationship, really because the Federal Reserve has already begun raising rates. I think this slide does a great job in showing what effect an incremental change in bond yields over the course of at least a year will have on the Barclays aggregate bond index's total return. And now that we can visualize this, the question then becomes how much and how fast will the Fed raise rates this year? And the gap between what the market expects the Fed to do and what the Fed forecasts regarding rate hikes has narrowed here in the near term. But expectations on the pace of these rates really still remain wide the longer we stretch out that time horizon, and that implies a much more gradual pace of rate increases compared to what the Fed forecasts. And really much of the good news about a go slow approach from the Fed, that's already priced in for the most part and removes a lot of the potential upside to that being a catalyst to bond gains. So with that being said, that's our little bit more in-depth look at our convictions behind the bond and stock market, and I'm going to turn it back over to Kurt.
Thanks, Ben. So, in conclusion, how do we embrace this new routine? What are some of the investment themes that we have and we should be looking for in the year ahead? The chart that we have here goes through various stock market indexes after the beginning of a rising interest rate campaign. Certainly some of these overall themes, as we've even started to discuss in the later half of 2015, increasing exposure to international markets, the potential for large caps to outperform small caps on the intermediate term. From a sector standpoint, stabilization of oil prices in that energy sector. Historically, it's been a great sector after the start of a rising interest rate campaign, and potentially lower oil prices could be even more positive on that front, as well as technology typically has done well. On the bond side of things, again, we still like high yield. It provides us the type of bonds that provide us the most insulation in a rising interest rate environment, mainly due to their higher yields. So just some final thoughts as we wrap up. 2016 certainly is going to have a lot in store for us. Increases in interest rates, it's an election year. Some of these out-of-favor sectors like energy potentially leading the way and driving growth in the coming year. But with the potential of increased volatility, we must maintain perspective as long-term investors and base our overall investment decisions as such. As always, if any of you have any questions, please don't hesitate to contact us. We've had over 70 different professionals, analysts, economists that have helped gather and put together a significant amount of content if you want any more detailed information. So with that, thank you for joining us.